There's a mistake I see a lot of members on this channel even doing, a very common mistake in crypto, and I call this mistake the Pokemon effect, the gotta catch them all effect, the over diversification effect, the effect that leads to cognitive overload, that leads to dilution of your market edge, that leads to average returns. So what happens usually? You've got some money saved up, you deploy your fiat currency on a centralized exchange, and then you're maybe searching YouTube for the best cryptos to invest in. So you watch various videos, you then like a certain influencer, you're subscribing to that influencer, and then that influencer is talking about a specific cryptocurrency. Maybe a cryptocurrency that's currently very hype. You're following other channels, you're following more and more channels, more and more influencers talk about a certain cryptocurrency, and so you get convinced that that cryptocurrency might make sense to invest in. You buy some, then you continue your journey, you still have some money left, you buy the next currency. Then you save up some more money, you put it again in the centralized exchange, you put it into another cryptocurrency. You're running this process for a while, for a year or two, and suddenly you end up with 30, 40, 50 different altcoins. This is a very common mistake I see people doing. People simply just allocate to their altcoins, the altcoins that seem to have a good story, that seem to be a good long-term hold. They rarely sell, and they simply just accumulate different assets. Now, if that's you, this video is hyper important for you. I've talked about this with various premium members that had the same issue. They show me their portfolio. They show me a portfolio of 30, 40 assets. If you're one of those people, here's the advice that I gave to those people. When you've got too many different assets, you've got different problems. The first problem is you don't really consider when to potentially exit that asset. And the issue is that altcoins are very much cyclical, right? They go up and down as a whole, but they also go up and down in individual values, right? If there's some news around an altcoin, the altcoin might shoot up, then the news aren't that exciting anymore, and the attention goes down, the price tends to go down as well. Very common behavior. If individual altcoins suddenly shoot up, and you've got 30, 40, 50 different altcoins, you're probably not even going to notice that a price quickly increased. You're probably not even considering to sell those short-term elevated prices. But it does make sense to sell altcoins when attention is particularly extremely high. Very often on this channel, I look at what are the retail investors doing versus what are the whale investors doing. I developed a tool to count the number of retail investors, to count the number of whales. Then I look at that count over time. And what I see time and time again across various assets is that the retail investors in aggregate rarely sell. We pretty much always just see accumulation. But the whales, they tend to sell. They tend to decrease in numbers as the price goes down. The whales take profit. And usually the whales make the better calls, right? That's why they are whales. They made money probably at least partially in crypto. And so when they do the selling quicker, maybe we can learn something from that. So the issue is you buy the most trendy cryptocurrency because that's what everybody is talking about. You're probably buying at high attention. Then you're riding the wave down, hoping for a recovery. That recovery doesn't quickly happen, and so you're simply just buying the next altcoin. Now, here's the problem with that over diversification, with that Pokemon effect. The issue is that you dilute your market edge. What do I mean? When you're trading crypto, we all intuitively know that the vast majority of people tend to not make money, right? The gains are concentrated in the hands of just a few winners. And those few winners are obviously the people that are best informed about a cryptocurrency. So if you follow a single project every single day very closely, you read every message in their Discord and in their Telegram and in their Twitter, you maybe even interviewed one of the team members, you're in super close contact, you probably have almost insider information. If you're that kind of a person, you're likely going to be in the top 10%. If you're not that kind of person, you're more likely to be in the bottom 90%. Now, if you have 50 different cryptocurrencies, how well are you really informed? Are you really among the top 10 most and best informed people among all of those cryptocurrencies? The answer is probably no, right? You're not in the top 10%. So it's pretty much impossible to beat the market, to be better than the average, if you dilute your attention across so many assets. Now, it's not just the attention that gets diluted, it's also your financial impact that gets diluted. If you make the right call on a cryptocurrency, right, you've got probably a ranking also, right? You've got 50 different cryptos. You probably have your 3 or 4 favorite cryptos. if you rank them, right, how likely is it that the best idea that you have is only marginally better than your 50th best idea, right? There's probably quite a steep difference between those ideas. So your best idea is super nice. Your 50th idea is probably not that great. Thus, why not focus all your attention on your best idea and becoming the top 10 to 5% in that asset, right? In that project potentially.
Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com.
With portfolio management, that's not necessarily that obvious of an effect, right? Because people think the more, the merrier, the better, etc. You've got more diversification, you've got price movements that cancel each other out, etc. But the issue is really within an asset class, diversification does not matter. Bitcoin is super highly correlated with Ethereum, is super highly correlated with your altcoin. If you want to get diversification, you have to buy across asset classes. You have to buy some crypto, but you also have to have some property. You also have to have some gold, some stocks, maybe some long-term government bonds. You need to have different kinds of assets that have very low correlation to one another to save yourself from those crashes. But if you just diversify within crypto, right? If you just have 50 different assets, you're not protected against a crypto crash whatsoever, right? When Bitcoin goes down, your entire portfolio goes down at the same time. You have not benefited whatsoever. You're not diversifying risk. So this is an excuse. It's an excuse that you get less risk by owning more assets. You don't need that many assets. Now, how many assets do you actually need? I personally think the ideal range is between 5 and 10. So you don't want to have more than 10 because then your attention gets spread too wide. But you also don't want to have only 2 or 3 assets because then you're so highly concentrated that in case one of those bets does not play out well, then your entire portfolio gets crashed down. So you don't want to have that. You don't want to have a high risk of ruin, but you also don't want to be heavily diluted in your attention and in your returns. You want to find the sweet spot. And the sweet spot depends on several things. It depends obviously on your risk tolerance. The less concentrated you are, of course, the more risk you potentially also take. But it also depends on simple things as in how much time can you actually invest. Can you invest enough time to follow 10 different assets very closely? To look into the Discord several times a day of 10 different assets? Probably not, right? Probably you can only do this for 3, 4, 5 assets if you don't do this full time. And so here's what to do about this, right? If you currently have 50 different assets, or if you even have just 20, 30 different assets, think about the assets that you have least conviction in. Think about the assets that you simply just bought on a whim. Think about the assets that you have maybe only a 2 or 3% allocation in, right? Cut those assets away from your attention, away from your return dilution. Take that capital and put this into your top positions. Dare to be more concentrated. Your overall portfolio volatility will not go up by having 10 assets instead of 30. The portfolio diversification has pretty much zero impact here. The portfolio volatility will pretty much be the same. Of course, assuming that you move to similar kinds of assets, right? If you have a lot of money in, say, Chainlink, and then you sell all the Chainlink and you put this into a microcap meme coin, of course, your overall portfolio volatility goes up. But if you simply just look, all other parameters equal, we simply just look at the number of assets, you do not have to go beyond 10. It's definitely more than enough. There is zero benefit in having more than 10 cryptocurrencies. It's really not required. You do want to focus on the highest conviction plays, and you do want to make enough gains when those conviction plays play out. And you do want to limit your risk quickly enough if you understand that something with that project is off, which you can only do when you don't follow 50 different assets. I know something like risk minimization, portfolio allocation, those kinds of topics are not necessarily that sexy on YouTube. That's why I have to package this video and this thumbnail a bit clickbaity probably. But I do understand that a lot of people actually enjoy this content. So I sometimes publish it on YouTube, of course, but the premium membership is actually focused on this kind of content. So in premium, I don't have clickbaity titles. I talk about the technicalities of portfolio allocation, of risk management, of asset picking, of blockchain analytics, of all kinds of different things. I talk about content that's skill developing. So if you're interested in that, feel free to check it out. It's thebitcoinstrader.com. We've got all kinds of things there. We've got also wallet tracking. We look at other influencers. We try to buy with the influencers before they promote this on their YouTube channel. So we buy early and then sell once they promote and the price goes up. We do all kinds of interesting, fancy things there. Feel free to check it out, thebitcoinstrader.com. There's also a video on that website that explains more details around this. Feel free to also give this a like. It helps the channel grow. Feel free to subscribe in case you haven't yet. And there's also a free Telegram in case you don't want to pay for premium yet. There's a free Telegram. Link is as well down below. Looking forward to chatting with you. Cheers.